Understanding kickers in financial instruments and real estate. What is a kicker? A kicker refers to a feature or option added to a debt instrument that enhances its attractiveness to investors or lenders. This can come in the form of a right, warrant, or any additional term that allows the holder of the debt instrument to potentially purchase shares of the issuer. Commonly used in finance and real estate, kickers can significantly influence investment decisions by providing extra incentives to investors. Alternative names. Kickers are often referred to as sweeteners or wrinkles, terms that denote their role in making financial products more appealing. Key takeaways about kickers. 1. Increased desirability. Kickers make debt instruments more attractive to investors, increasing the likelihood that they will purchase. 2. Incentives. They provide an additional incentive, potentially increasing the expected return on investment, ROI, for investors. 3. Equity kickers. Common forms of kickers include convertible bonds and stock warrants, which allow investors to participate in the equity upside of the issuing company. 4. Real estate context. In real estate, kickers may involve a share of property income as part of mortgage agreements, enhancing loan approval chances. How do kickers work? Kickers function as a strategic tool employed primarily for the benefit of lenders. For instance, when a lender is hesitant to provide a loan to a startup due to financial uncertainties, the startup might propose a kicker, such as an equity stake in the venture. This not only opens a path for funding but also aligns the interests of the lender and borrower towards the company's success. The mechanics of equity kickers. Equity kickers incentivize investors to consider purchasing debt securities because they can lead to additional returns based on the company's equity performance. Below are two common types of equity kickers. 1. Convertible bonds. These bonds contain provisions allowing bondholders to convert their bonds into shares at a predetermined price, typically if the stock performs well. 2. Warrants. These are attached to bond issues, permitting bondholders to buy stocks at a specified price, enabling them to benefit from potential increases in stock value. Application in leverage scenarios. Kickers are particularly prevalent in high-risk financing situations, such as leveraged buyouts, LBOs. Management buyouts, MBOs. Equity recapitalizations. These scenarios typically lack traditional financing options, so companies often add kickers to attract investors and lenders. Real estate kickers. In the realm of real estate, a kicker might manifest as an agreement where a lender is entitled to a percentage of the total income or rental receipts from the property financed. This arrangement is especially relevant when the borrower faces challenges in providing a substantial down payment or when there are perceived risks involved in the transaction. Examples in practice. For instance, if a lender supports a real estate project with a high-risk profile, they might require a kicker, such as a percentage of profits gained after renovations, to compensate for the increased risk associated with the investment. Special considerations in using kickers. While kickers can be beneficial for both parties in financial deals, it's crucial not to confuse them with kickbacks. Kickbacks are illegal incentives or payments made for favorable treatment and are heavily regulated under laws like the Real Estate Settlement Procedures Act, RESPA. RESPA mandates full disclosure of all terms and costs in real estate transactions, aiming to protect consumers from unfair practices. Conclusion. In summary, kickers are a significant element in both debt securities and real estate transactions. They serve as compelling incentives that can make investments more attractive and facilitate funding in high-risk scenarios. Understanding kickers can help investors navigate the complexities of financial instruments and real estate financing, augmenting their decision-making process and aligning various stakeholders' interests. By recognizing the potential rewards and inherent risks associated with kickers, investors can make more informed choices regarding their investment endeavors.